Hello and a very happy new year to you. It's early in the new year yet. We've just had our first investment committee meeting of 2018 and I want to bring you the news and views from that. In general, so far this year we've seen markets continue in the flavour of the regime we saw at the end of last year, the last 3 to 6 months of last year. Global growth is very, very strong. Rates are low. We have a degree of clarity on the outlook for central banks. We expect 3 rate increases from the Fed this year. And of the other central banks, for example, the Bank of England should raise rates twice over the course of the next 12 months. So equities continue to hit highs. Don't be surprised if at some stage we get a little air pocket, a small correction. And this high liquidity, low volatility environment is still in place. Low volatility itself is both a risk and an opportunity. In terms of risks going into the year, I think the key risk, everyone looks at politics, what's happening in North Korea. I think the key market risk is long-term rates and inflation. We're keeping a close eye, for example, on US 10-year treasuries, which have just hit 2.6%. But macro-wise, the key risk is inflation. And in that regard, we've made a number of changes in our portfolio. We add inflation-linked bonds as an outperform. The UK, where we're getting some clarity now on Brexit, where growth is beginning to stabilise. We expect GDP in the year ahead to come in at 1.8%. We should see inflation remain strong in the UK, so we move UK gilts from a neutral to an underperform weighting. Staying with the UK and just to move into equities, UK equities have underperformed in the course of the last year and we were underweight and we now close that out. We also close out our view on Swiss equities, which we've had for some time, and taking that down from outperform to a neutral weighting. And again, staying with Switzerland, the last 5 to 6 months has seen the Swiss franc weaken as investors generally have taken on more risk appetite, and as they've done so, a lot of the safe haven assets like the Swiss franc have fallen. We think that fall now is generally over. It no longer looks expensive relative to other currencies in terms of our framework. So we close out our views on the Swiss franc relative to the euro and relative to the dollar. And we think its underperformance has, for the time being, come to an end. We've made a number of other relatively smaller changes. Australia, for example, Australian equities moved to neutral. We had been underweight the utility sector in equities, and with the spike in bond yields, that has continued to underperform, and we close that view out and close out our view on consumer discretionary. So I think a number of changes here, some of them focused on picking up the potential for inflation to rise, others closing out views that have worked quite nicely towards the end of last year, the weaker Swiss franc and weaker UK equities in particular. In general, we like equities as an asset class. We like Europe as a region. The macro looks very, very solid there. Political risks are still, I think, in the background. And in Europe, our favourite country market at the moment is France. We also emphasise our super trends. These are very, very big macro or tectonic trends that are going on in the world. Things like demographics, the move towards a multipolar world, and one I think we are going to release research on very soon, angry societies or the future of politics. So watch out for the future of politics as the World Economic Forum in Davos comes up upon us in about 2 weeks' time. Thank you.